By 2026, economists are putting global recession odds at 35%. But here's what they're getting wrong. Everyone's watching Wall Street. They're staring at the Fed, obsessing over inflation data, tracking every S&P 500 tick. But what if I told you the spark that ignites the next financial wildfire won't come from New York at all? What if it erupts from the shadows of Shanghai or the crumbling debt towers of Rome? Here's the uncomfortable truth. Crashes don't announce themselves with a press conference. They erupt from the edges, from places we're not watching closely enough. So here's the question. Are you watching the right threats? Because in the next 9 minutes, I'm going to show you where the real danger is hiding. Let's map the threats everyone else is missing. Here's what makes 2026 different. The US economy? It's actually pretty resilient right now. The AI boom is cushioning tech sectors. Job markets are stabilizing. But here's the catch. We're living in the most interconnected financial system in human history. A domino falls in one corner of the world, and suddenly your 401k is bleeding red. Think back to 2008. Yes, it hit American banks hardest, but it started in American subprime mortgages. We saw it coming, sort of. But 2026? This time, expect the unexpected. I've identified 5 global hotspots that could trigger the cascade. Italy and France's debt volcano, China's $50 trillion shadow banking black hole, the commercial real estate time bomb in US mid-tier cities, Middle East oil choke points, India's retail investor bubble. We're going to dive deep into the 3 wildest scenarios that keep central bankers awake at night. These fuses, they're already lit. Picture this. It's spring 2027. France's elections have just concluded, and populist movements have gained serious ground. The bond markets panic. French government yields spike overnight. Now here's where it gets terrifying. France's deficit is running at 6% of GDP. That's worse than Greece was in 2010 before their crisis. And remember how that turned out? But France is just the match. Italy is the powder keg. 3 trillion euros in debt. That's 140% of their GDP. One default, just one, and the entire Eurozone fractures. Here's how the contagion spreads. First, capital flight. Investors dump European bonds and run to safety. But wait, American banks? They're holding over $500 billion in European assets. JP Morgan, Goldman Sachs, Bank of America, they all have massive euro exposure. When those assets crater, guess where the pain shows up? Your pension fund, your mutual funds, your retirement account. It's not as sexy as Lehman Brothers going bankrupt in a dramatic weekend. It's slower, more insidious, and potentially deadlier to the average investor. The European debt volcano is rumbling. But honestly, Asia's shadows are even darker. Let's talk about something most Americans have never heard of: China's shadow banking system. You know about China's real estate crisis, right? Evergrande collapsing, ghost cities, empty apartment towers? That's yesterday's news. The real threat? Shadow banks. These are unregulated lenders operating in the darkness of China's financial system, and they're hiding, get this, $50 trillion in loans. Let that sink in. 50 trillion. That's twice the size of the entire American economy, and it's all sitting in a regulatory black box. These aren't your typical banks. They're wealth management products, trust companies, peer-to-peer platforms, all interconnected, all leveraged, all unregulated. And here's the nightmare scenario economists are whispering about. One major province defaults, just one, and economists estimate it could erase 2% off global GDP overnight. But the ripple effects go way beyond numbers on a screen. Think about your daily life. That iPhone? Made in China. Your car parts? China. Your medication? Probably China. When Chinese shadow banks implode, credit freezes, factories shut down, supply chains that took decades to build just stop. American manufacturers can't get components, shortages everywhere. And then China does what it always does in a crisis, devalues the yuan to stay competitive. Suddenly, cheap Chinese exports flood global markets, crashing commodity prices worldwide. It's 2008's collateralized debt obligations all over again. Same financial engineering, different language, bigger scale. But there's one more player in Asia that could light the match: Japan's yen carry trade. For years, investors have borrowed yen at near-zero rates to invest in higher-yielding assets worldwide. Trillions of dollars in these trades. If the Bank of Japan raises rates suddenly, or the yen spikes, that's a margin call heard around the world. The unwinding could be catastrophic. Asia isn't just a risk, it's a loaded gun. Now let's rapid-fire through 2 wildcards that could accelerate any crash. First, the Middle East powder keg. One military escalation between Iran and Israel. One miscalculation, and suddenly the Strait of Hormuz, the narrow waterway that 20% of the world's oil flows through, gets blockaded. Oil prices rocket to $150 per barrel, maybe higher, and suddenly everything Everything gets more expensive. Your groceries, your commute, airline tickets, shipping costs. The inflation that central banks spent years wrestling down, it roars back with a vengeance. Interest rates spike. Consumer spending collapses. Second wild card, India's retail investor bubble. The BSE Sensex, India's main stock index, is up 300% in just 5 years. That's .com 2000 territory. That's tulip mania levels of exuberance. 100 million new retail investors, young people, first-time traders, have piled into the market. Mobile apps made it easy. Social media made it exciting. And now, 40% of stocks are trading at valuations that make no fundamental sense. When this bubble bursts, not if, when, it doesn't stay contained in Mumbai. Emerging market funds that invested in India's growth story, they panic sell across all emerging markets. Brazil, Indonesia, South Africa, they all get dragged down. And here's the kicker that ties it back home. Even America has its hidden vulnerabilities. U.S. commercial real estate, those empty office buildings in mid-tier cities, represents over $1 trillion in loans on regional bank balance sheets. When the global shock hits, those already stressed banks amplify the echo. The crisis that started abroad becomes your crisis. Spot the spark and protect yourself. So here's what you need to understand about 2026. The next crash won't whisper warnings from Washington or announce itself on CNBC. It'll roar from places you weren't watching, from Rome's debt crisis, from Riyadh's oil choke points, from Mumbai's bubble or Beijing's shadow banks. The question isn't if one of these dominoes falls. The question is which one falls first and whether you'll be ready. So what do you do with this information? 3 things. 1. Diversify globally. Don't keep all your eggs in the U.S. stock basket. Consider emerging market bonds, gold, international exposure. 2. Watch the indicators. The yen carries trade unwinding. Oil futures spikes. European bond spreads are widening. These are your early warning systems. 3. Stay educated. Knowledge is your airbag in a crash. Subscribe to channels like this that look beyond the headlines. If this video scared you smart, good, that's the point. Hit that like button, subscribe for more crash-proof financial strategies, and drop a comment. What's your wild card for 2026? What threat am I missing? Because in investing, the danger you don't see is the one that destroys you. Stay vigilant out there.